Hi, little accounting nerds. I hope you're all doing good. And I'm back. Your accounting teacher is back with a new topic. Today's topic is going to be how the elements of financial statements are accounted for um, when we do the journal entry, when we create ledgers, how we will actually be debiting it or crediting it, and why. So we have got here five elements, which I've already talked about. There are five elements. Three will go to the balance sheet, and two will be the part of profit and loss. So if we talk about the asset, whenever the asset is going to increase, we are going to debit the asset and credit it when it decreases. So for instance, I'm buying something, I'm buying an equipment, I'm buying a laptop, I'm having some cash, I'm buying the equipment, the sofa, the chair, the TV, all of those things that the business need in the office. If I'm buying that, that's going to be my asset, and that would be my non-current asset. I've already talked about the types of assets and liabilities. So anything heavy that's expensive that we buy goes to the asset category. So when the asset increases, when I say I'm buying something, I've bought it, or I have some accounts receivables. We haven't really talked about AR, but this is what this is something. This is the money that we'll be receiving from our customers, right? Because businesses operate on credit basis, so we sell things, but we don't get the money on the spot. So that's what we call AR, accounts receivable, which means we will be getting money in the future, but this is going to be the current asset. So anything that falls into the asset category, whenever it's going to increase, we are going to debit it, and whenever it's going to decrease, we are going to credit it, right? And let's talk about liability. It's the complete opposite of the asset. Asset means we own something. Liability means we owe something to other people. And it has also its categories. It's non-current liability and current liability. I've already talked about it. So for instance, let's talk about AP, which is accounts payable, which means I have bought something from my supplier, but I haven't yet paid them. So I need to pay them in the near future. So the moment I bought goods from the supplier on credit, it increases my liability towards him, right? Because I haven't yet paid him. So whenever my liability is going to increase, I'm going to credit it, and whenever it's going to decrease, I'm going to debit it. So for instance, I bought $1,000 worth of stuff from the vendor. The moment I buy it, it's gonna increase, right? I owe the vendor this thousand, so I'll credit the vendor account. And the moment I actually pay him, for instance, I pay him 800 tomorrow, then I'm going to decrease my accounts payable account because my liability towards him has decreased from 1,000 to 200, right? Because I've paid him this, and the net value that's remaining in his account is 200 now, right? So now, since I've paid them, it has decreased. Capital is something that the shareholders invest in the business. So whenever the business is going to wind up, like it's going to close up, it's going to dissolve, anytime in the future, then we need to pay all the money back to the shareholders. So capital is also a kind of liability. It's something like a business owe to the shareholders. That's why its treatment is the same as the liability treatment. So whenever it's going to increase, whenever there is an investment from the shareholder, we are going to credit the capital account. And whenever the shareholder is going to withdraw the money, I'm going to debit it because it's going to reduce. So these three are a part of a balance sheet, and this is how these will be accounted for. This is a debit credit treatment for these three, and these two, income and expenses, is a part of the profit and loss statement. I've talked about it already. And the treatment for this is whenever we sell the product that the business is making, we receive the money from it, right? So the money that we receive by selling the product, the main product that the business is creating, and we sell it and we get the money out of it, then we are going to credit it because income is increasing. And whenever there is any sales return or something, it's going to reduce the income. So we will debit it. For expenses, whenever they're going to increase, I'm going to debit them, because expenses is a total opposite of income. So the treatment of the expense will be opposite to the income as well. So if we are debiting when the income is decreasing, then we will be then we'll debit the expense when it's increasing. So a total opposite. You can remember it that way, and you don't have to think a lot about this debit and credit and the increase decrease thing, because it's an objective thing. It's not subjective. It's an objective rule that you need to just keep in mind and not overthink about it. So just create a schedule with you like this, and whenever you solve a question, you just look at until you actually remember and keep it in your mind. Just look at the schedule that you create for yourself, and you see a transaction, and then go here. Okay, asset is increasing. So what should I do? Okay, debit it. And it's decreasing. Okay, credit it, until you actually learn it on your fingertips, because this is the first and foremost thing before you actually move on to learn accounting even more. So I hope it's clear. In the next video, I will be sharing an example with you, and we will solve it together just to understand this a bit more. Thank you so much for your watching, and stay tuned.